Okay, in this module, we're actually going to talk about launching, building, populating, constructing, and simplifying your lean canvas, right? So first off, what is a lean canvas? A lean canvas was made, very popular by the lean startup. It was a movement that took place maybe a decade or so ago. And we do link to different resources in the OS system that actually give some background and context. Please do check it out because there's a lot of valuable information in that movement onto itself, of which one of those many things was the lean canvas. And put simply, it is a simple way of building a business model, right? So at its core, that's what it's intentionally designed to be, is quite literally a lean business canvas, a lean business model. Long gone are the days where you have to go and put together a 50-page document to put together a business plan that you can then go to get funding or whatever the case may be. Lean Canvas did a ton in terms of making that shift and making it accessible and acceptable both for folks to do something simple, be able to share it and rally around it, make changes. It's all about, testing out ideas and making very quick iterations and pivots to ultimately get to something that makes sense. We love it. So Bootstrapper Capital loves it because A, it's simple. We're all about keep it simple. B, you can literally have an entire business conversation on one screen. So I'm about to walk through ours in today's module as I walk through how to do your business canvas so that you could follow along. Not what you should do, but it's just what we did, right? So I'll tell you what we did and how we use it. And then also, there's this common misconception that the lean canvas is only for, pre-seed startups or, folks that are just getting started. The reality is not the case. We actually ourselves use the lean canvas in our advisory business when we'll work with middle market companies. And one of my favorite things in the world is to sit down at a board table or in a room. I mean, less so these days in a room, but still the concept is the same. I mean, if you can get folks in a war room, that's usually the best, and I don't think that that's ever going to change. But yeah, the concept of getting an executive team together and then throwing out a lean canvas and having everybody complete a lean canvas in a middle market organization or growth organization, I thoroughly enjoy that experience. Like, very much so, folks think that, I don't know, maybe they're too sophisticated for something like that, but it's funny to experience how sometimes keeping it simple and forcing folks to live within the constraints of simple is very challenging and oftentimes refreshing in terms of a new perspective, right? Change your perspective, change your approach. So we also use it for any stage organization. I'll put an asterisk there. The organizations in which we work with are, early, bootstrappers all the way up through middle market growth organizations. But we find value in pushing the adoption across the gamut, left to right. And it's all about, again, simple, keeping things simple and then getting on the same page. So I'm going to walk through the lean canvas. So that's why behind it. I'm going to walk through the actual workshopping of putting it together. Now, for essence of time, I did already go through and complete this canvas. So that way you don't have to sit here and watch me type, which could be time consuming or like have to think about things. So for efficacy of this video and this workshop itself, all of this is already completed. Now, what I would like to do though is talk through it as though we're doing it live, and this way you can follow along, you can follow the thought process and then complete it. Pause at any moment in time and then complete it, on your own for your business specifically. Now, the first thing that you're going to notice when you look at the lean canvas here is there's numbers. And there's a very specific process. I mean, you would kind of ask yourself, like, why isn't it from left to right following this sequence? And to be perfectly honest, I actually don't know. I'm sure there's a why behind that. Probably should have looked that up before doing this video. But I just wanted to acknowledge the fact that there's these numbers that kind of give us the sequential order of how we attack this and approach this, right? And the first thing that we're going to start with is the customer segments. And when we're talking about our customer segment, what we're really trying to do is narrow down and get as specific as possible in terms of who we're targeting, right? That's pretty important. Now, in this situation, what I'm designing the canvas for is specifically the advisory arm of Bootstrapper Capital, right? So I'm building this around our performance advisory business. Our performance advisory business is pretty straightforward. We help organizations build wedge equity, and we do so through the medium of the SAFER agreement, our simple agreement for future exit and revenue receivable. So just for context, that's what this is designed around, is our performance advisory business. Now, before we get into the customer segment, what I would like to do is start with that high level concept, right? And that high level concept is, think of it as almost like your elevator pitch, your 1 or 2, maybe 3 sentences at most elevator pitch of what your business is at its core, at its essence. So exactly kind of what I just did. So we help businesses build wedge equity with the goal of acquiring them for more than they are worth today, right? That's what we do. We help companies build wedge equity. And the why behind why we do it is to hopefully acquire them in that process for more than what they're worth today. So we'll help a business build wedge equity. I could probably just end it there, right? If I wanted to truly keep it simple, we help businesses build wedge equity. But for me, I tend to like to know the why, right? By connecting the why, it kind of connects deeper in terms of the purpose and the intention. And then as you're working through these canvases, by knowing your why and following your why, you can ultimately ask and challenge yourself to go a little bit deeper, right? So I want you to take a second to just think about who it is that you are, right? What it is that your product specifically is. What do you do, right? What is the essence? And if you connect it to the why, that's awesome. If not, just kind of like, abbreviate it and keep it simple. In our situation, to keep it simple, again, would be we help businesses build wedge equity, right? So that's the high level concept. Once you got your high level concept down, now we're going to navigate through and follow those numbers, like I was mentioning earlier, and we're going to complete the rest of this canvas around that high level concept, right? And again, it's all pretty much around it, quite literally. So we'll work through this together. Before we move deeper in, the other thing that I want to acknowledge and note up front is some of these are, black and or grayscale, and some of these are color coded, right? This is important to note up front. If you have multiple customers or different segments, use color coding, because as you work through this, what you can do is complete it per customer segment, and you can just label it using the color. So denote it. So for example, here I have 2 customer segments, one's blue, one orange. And then when we pop over to solutions over here, one's blue, one is orange, right? For me, I use black or gray as the standard, meaning it's interchangeable. It's just universally accepted, right? That's how I've approached it here. Feel free to put your own little spin on it if you want to have different form of organization, but that's the goal here at the end of the day, or the why behind this. So we're going to jump into the customer segment. So again, the customer segment is, we want to get narrow in terms of who we serve, right? Who are we targeting? A great thing that I like to fast forward videotape with when thinking about who we target is these other things that we're going to be tackling. Like, what is the problem we're solving, right? So the problem is the problem for these individuals, for the segments, right? What are the channels? Meaning, how are we getting these people? Right? You may even want to think about some of your early adopters up front. I like to read through the canvas and kind of mock do it first. So just to pull back curtain a little bit. Typically when I do a new lean canvas, I'll run through the entire thing high level. So that way I kind of have a sense of what my talking points is. It helps me kind of refocus. And this is just the way that my brain works. Everybody's brain is different. But knowing where I'm going oftentimes helps me get focused and simple with where I am. Right? And that's the why behind that. So when I look at our customer segments, we really have two offerings, right? We have one offering for anybody who's doing less than $100,000 a month, and that's our community-oriented, community boot camp approach to performance advisory. And then we have an offer for anybody who's doing more than $100,000 a month, and that's our one-on-one performance advisory, right? Both of our performance advisories, it's ultimately the same offering. It's just different in terms of the way that we deliver it, and it's different based off of who we're delivering it to. But no matter what, we're still helping businesses build wedge equity, right? So we have one offer to help anybody who's doing less than 100,000 build wedge equity, and another offer who anybody's doing more than 100,000 a month build wedge equity. And the difference is the how, right? So take a second and think about your own customer segments. Again, cheat code here. Look through these other categories that we're going to be working through on the canvas, and use that to kind of spark and ignite some creative juices flowing, and then try to get as specific as possible. This is pretty specific for us. I could go deeper, right? In our actual handbook, in our actual operating system, we get super specific. So we say, as of this moment in time, USA or Canadian based. We go even deeper in terms of the number of folks on cap tables that we like to deal with. We go even deeper in terms of the niches and the verticals that we like to deal with. But for purposes of Lean Canvas, purpose of this is more than adequate for us, right? To just give you a sense of keep it simple. All right, so the next thing that we're going to jump into for the workshop is the problem that we're solving, right? So now we know who we're targeting, but what problems are we solving for them? So think about the folks, right? The folks that have a sub $100,000 business, they're solving for different problems potentially than the folks that have more than $100,000 business. In our situation, uniquely enough, they're actually pretty much the same problems. And that's why you don't see anything color coded here. But, if we wanted to get really kind of in the weeds, I could differentiate, but I chose not to. I made a choice. And the choice that I made was to just focus on a singular path of a problem that could be solved for both channels, for both segments. And in our situation, we're solving realistically, again, for building wedge equity, right? How do you build wedge equity? And I guess realistically, now that I'm thinking about it, I'm going to fix this. Right? So the change I just made is to specify the fact that we're building wedge equity. That's the problem that we're solving for. How do you build wedge equity? The way we do that is to implement an operating system. That gets us our first bracket of new equity that we can create. And then after we implement the operating system, what we do is we get more profitable customers, right? The problem that's really being solved here, though, why do you want more wedge equity? Is realistically for folks who are raising capital, you want better terms from investors, or from somebody who's selling a business, you want a better valuation, right? The wedge equity gets realized in the liquidity events. And the liquidity events for us are raising money or selling the business. And the whole goal here is to build as much wedge equity or much equity in the business container as you possibly can going into these liquidity events. And that's why in our conversations and in our decks, what we really talk about is helping companies get capital ready. And when we say help them get capital ready, what we're trying to do is help them get capital ready by building wedge equity so that they get better terms from investors, better valuations for acquisitions. Right? So when we look over here, that's the problem. think about your problem. Think about what you're solving for your customers. Try to segment it if you possibly can, right? And again, you may end up working through this and realize that the first time is just going to be a high level 20,000 foot. And then the second time that you work through it, you may start to use things like these little toggle downs and you start to go a little bit deeper into it. In this situation, I actually went and implemented an OS and get more profitable get more profitable customers. That's actually the solutions, and we'll find that as we work through. So I'm kind of like already embedding some of these things, and that's perfectly okay because this is designed. I mean, this isn't meant to be perfect, right? Nothing in business or life ever is. And what it really is meant to do is to get you thinking in frameworks, getting to work frameworks, and then letting yourself leverage those frameworks to focus in, get simple, and then drive to outcomes in your business, right? And this is just a process to be able to do that. So once we work through our problem, the next thing that we're going to get into is our revenue streams, right? So we're going to jump down to 3 down here, revenue streams. And what we want you to do here is to list out any and all revenue streams that you'll be able to generate from the products that you're positioning to that customer segment, right? So think about the ways you make money is another way of saying that. In our situation, we make money by getting the terms from performance-based capital. So by providing our advisory services to build the wedge equity for our clients, we make a small investment in the company and then we get paid back from a percentage of the revenue over time. And that's how we get paid cash flow. So that's one way that we make money from cash flow perspective. And then the second way we make money is through the wedge equity, right? So in our simple agreement for future exit and revenue repayment, one part is the revenue repayment. The other part is the agreement for future exit. And if we're building equity in these companies, we also have the option to acquire these companies through our safer agreement. And it's through the equity that we actually build on the partnered upside, aligned upside, that allows us to then also, do deals and make money, right? So we make money, cash flow from the performance capital terms, and then the second is from the wedge equity. Think about the ways in which you make money, write them down, try to connect them specifically to the customer segments and the problems that you're solving, right? And then that's going to drive us right to number 3 to 4, from 3 to 4, which is the solution itself, right? So in the solution, what I want you to experience, what I want you to go deep into isn't the what, but more the how, the experience, right? So I want you to get into the experience that the customers are going to be having with your product. So in this situation, you'll notice I went back to color coding because in this situation, something that's different is the experience per segment. So again, blue was the sub 100K businesses a month. And in that situation, the delivery, the experience, the way that we solve the problem, the solution, the customer experience for that solution is community driven. So we'll onboard folks into the community. In fact, you're probably going through it right now if you're watching this video. You'll get access to the content, the structure strategies through the community. That allows us to lay a foundation at scale, let folks kind of grind it out and earn the opportunity to then participate in the backside of it, which is the accountabilities. And that's when we're able to align into the upside once the foundation's been laid and drive results. So it's a community-driven implementation of the OS, right? The other thing that we do is community-driven adoption of growth strategies, because the two things that we focus on to build wedge equity with businesses is the implementation of an operating system and then more profitable customers, right? So those are the two things that we focus on delivering to drive wedge equity, ultimately, create wedge equity. Now, when it comes to 100K or more in revenue, the only difference here is the approach, right? Change your perspective, change your approach. In this situation, the perspective is these clients, these portfolio customers, companies are ultimately compensating the firm more because the terms are larger. Because the terms are larger, we're getting compensated more. We change the experience, and the experience shifts from a community-driven experience to then a one-on-one personal experience, personal touch experience. And that's because realistically, you're adding another zero at the end of the terms for these deals, right? We don't do a deal that is less than $1 million tied to the one-on-one, right? Whereas we'll do a deal for 100K at the community driven. So when you're thinking about your solution, again, think about it from the lens of the experience of that customer segment, right? Once you work through the solution, the next thing that you're going to talk about is the unique value proposition. And the unique value proposition is what's going to make you different in the eyes of your customers, right? So I want you to think about this from the unique eyes of your customers, as opposed to the unfair advantage over here, which sometimes is, a confusing, like there's a little bit of confusion. Unfair advantage is going to come from the eyes of your competitors. Unique value proposition is from the eyes of your customer. When your customer is looking at you versus your competitor, what do they see that's different about you? What makes you special, right? And that's important. In our situation, we have pretty universal unique value propositions. First and foremost is we're not just affordable, but we're actually flexible in terms of our payment structure, right? So we align into the revenue of an organization. Our cash flow, our performance advisory fees comes from the ebb and flow of your revenue. So we take a small percentage of your revenue over time. As it goes up, it goes up. As it goes down, it goes down. We're aligned. We're not going to become a draw or a burden on your business because of the structure. So we're super affordable, super flexible in our affordability, which the flexibility is probably the most important thing, as opposed to other firms or other options or other competitors, alternatives in the market, which are more fixed or more burdensome. I did put our safer agreement structure in here, which is realistically how we become more affordable and flexible. It's just more specificity for me. I do think that our safer agreement, it's unique to us. We created it, trademark us, right? We have the intellectual property around it. It's our agreement. We invested in it. So it's a unique value prop for us, right? We do that when other people can't. We also offer guarantees, right? So we come at this and we guarantee, if you follow the script, if you follow and meet the terms and obligations of the agreement we enter, we'll guarantee the wedge equity, right? Or we'll keep working with you until we achieve it. That's our performance guarantee. And then the other thing that I think is really unique about us is because we're truly in the business at the end of the day, we're a micro private equity firm. So right now we're talking about our performance advisory business, but at our heart, who we are, we build, buy, and sell. Most importantly, buy. We're a micro private equity firm. We're building a portfolio, $100 million portfolio, 100% public. We are in it for the true partnership. So when other folks say, hey, we're partners, and you hire some agency or a consultancy firm, you're just another number on the spreadsheet for them. Reality at the end of the day, unless they're getting some sort of equity on the upside, which is, again, there's a whole nother conversation as to why you shouldn't do that. With us, we're in partnership because A, we get paid when you get paid. So our performance is tied to your performance on the payment side, compensation structure. And then B, we have the ability to acquire your business, and that's what we're in for. So we want to see you succeed. We want to build that wedge equity, not just because we guarantee it, but because ultimately by doing so, we could potentially get a deal done and everybody wins in a big way, right? That's how you go from a few $1,000s to, ultimately being a good, meaningful liquidity event or economic event for everybody. So I think that truly is unique in market. And I think it's special. I haven't seen anybody else doing anything even remotely close to that. So pretty proud of it, to be honest. Actually proud of a lot of the things that we do. All right. So think about what makes you special, right? That's what makes us special. Think about what makes you special in the market in the eyes of your customer. Now we're going to jump down to the channels. When we say channel, what we're really meaning is the way in which your customers or these customer segments find out about you, right? Like, how do you actually get the attention and the awareness to then drive a sale, a potential, an opportunity for a sale to drive revenue and make revenue from your revenue streams by solving somebody's problem, by offering a solution that's unique in the market, right? In our situation, these are actual channels that we use. We work with all of the acquisition platforms out there. There's a lot of buy sell. When I look at channels, what I really love to do is focus on the ones where you have a unique competitive advantage of a really good alignment of need, right? So if you can find someplace in the market where somebody's already raising their hand that they need the solution that you offer, where they have the problem that you can solve, that's a great place that's low-hanging fruit to solve for, right? That's why I kind of like marketplaces like Upwork and stuff to a certain extent make sense, because it's a congregation of needs, right? Vendors and suppliers in a sense. You can do that in any market. You can find it in any market. In our situation, acquisition platforms are a great source, a great channel for us, because it's quite literally folks raising their hands and saying, hey, I want to sell my business, right? I want to sell my business. And typically the conversation is clean to be able to say, hey, do you want to sell it for more? Right? It's somebody who wants to sell their business. We are in a position to help them sell it for more. And not only can we help them sell it for more, we can also be the person that buys it. So not only are we solving their problem as being the buyer, but we're solving their problem in a better way by getting them to sell it for more, right? So that's a really great fit. That's a really great product market fit for that channel. So we see strong lead generation there. It's also fairly evergreen, and you can then leverage the economics of these other platforms because they're spending a ton of money attracting, these deals to them. So that's also an economic way of solving for that. Crunchbase or other similar listing sites is another popular one, right? We target also folks who have just gone through some sort of recapitalization. Maybe they just raised a Series A. Typically, folks who are cash flush tend to have operational issues, right? So the moment in time in which companies have capital is also oftentimes when things get complicated and they stop keeping it simple, and then they need a little bit of help there to keep it simple. So you see that all the time with like seed to really Series A, like once they get, $1 million or so in their bank and they're growing with employees and stuff, and they go from being founders, then they have to be more of an executive leadership team and things of that nature. You need processes, and you need all the things that ultimately an operating system delivers and don't naturally take place. So that's a problem to solve for. So we tend to find more of our 100K plus, advisory clients from those channels. I guess I could actually segment these. This would be blue and this would be orange, but honestly, we see them across the board. So there is overlap. Also, referrals. Referrals are a great channel because folks that are worked with you and are happy, they're likely to refer you to other folks who have similar problems. That's your best advocate at the end of the day. It's typically your cheapest acquisition channel. And then ecosystem partners. For us, ecosystem partners are vendors who provide solutions that we adopt and use in building wedge equity, as well as other players inside of this ecosystem, newsletters, things of that nature, that are just in this market of build, buy, sell, right? Folks where the audience, our core audience, lives. So think about where your customers live, right? Think about realistically the places where they're already raising their hand and saying, I have this problem. And that's a great place to start, right? That's a great place to start in terms of your channels. Ultimately, less is more here. Get one channel working really well, like test out a couple of channels, get one of them performing very, very well, get it consistent, right? Producing very good results in terms of lead generation, and then start to add complexities to it. So less is more here. More does not mean more necessarily. All right, key metrics. So now that we know who we're serving, what problems we're solving, the solution we're providing, the channels we're approaching, what makes us special in the market, how do we know if we're doing well, right? The key metrics are realistically a way to track the progress of the business. It's an indicator of if we're doing good. Are things going okay or not? We're big fans of metrics, like quite honestly, because we stand up the OSs and we're very operator heavy in terms of like outsourcing the portfolio plays and all these things. For us to be able to do what we do at scale, metrics are key, and simplicity of metrics is even better. When we look at the performance advisory business, there's a couple of key things that kind of tell us if we're doing well. First things first is the safer agreements. Like, how many are we closing? I mean, we do get deeper into this, like how many did we send versus how many we receive. But I mean, a simple number is just how many did you close? How many signed agreements do we have? Is it trending in the right direction? Right? If there's trending off, there's a problem. What is the problem? That allows you to focus more upstream in the business system of where the constraint is. Like, why aren't we signing more agreements? All right. So when you're thinking about these key metrics, really think about the things that connect you to your why, right? And can have you ask the why question. Why is this? And then you can go and figure out what's wrong so you could fix it, right? Number of deals. By deals, I mean like actual deals that we're executing. So in our safer, it's a simple agreement for future exit, right? So exit. This is now the indicator of the exit within the safer agreement. So we have signed safers. Now how many are exiting? How many are we acquiring or wholesaling off? How many deals are we getting done? If we're not doing deals, that means that the agreements that we're signing aren't great agreements, or we're not signing great agreements with great businesses. And there's a problem. There's a constraint there. Solve it, right? Next level down is the defaults, right? How many, you could change this from default, which is negative, which we do use a default rate here. Or you could say how many successful repayments have been, terms have been completed, repayment terms have been completed. Because again, simple agreement for future exit and revenue repayment. So if people are not paying you back, they're defaulting. If the default rate is high, again, there's something issue with the agreements or the businesses, we can solve it. Also, if they are, completing their payments, that's positive. Same information though. I look at the defaults here. And then the final thing here is income. And I highly suggest that every business universally keeps track of their income as one of their primary key metrics, right? How much cash is actually coming in. And by income, you could mean cash flow as well. So think about your key metrics. Think about like, what if you only could get a sheet of paper, right? And you only had one sheet of paper every day that was provided to you. What information do you need to know as an owner of your business to know whether or not things are going right or things are going wrong? That's a great way to think about your key metrics, right? Start there, start simple. All right. So that's 7. In terms of 8, now we're getting into the cost structure of the business, meaning like start to plan financially. Over here to the right, we had revenue streams. This is how we make money. Now to the left is how we spend money. What does it cost to actually run and solve this problem for this customer in the market, bring this solution to market so that we can work the channels and hopefully drive the revenue streams. From a cost structure, list the variable and the fixed cost, right? Like get pretty specific. You want to have a good sense of what this is going to cost. That's one of the primary, left and rights that you need to be able to plan for when you're making good, timely business decisions. In our situation, you have the product development cost, which for the most part is also tied into the salaries. But, product development, its own thing. We're always optimizing, always be optimizing. So always also be building, improving realistically. Always be optimizing. So there's always going to be a development cost. Marketing expenses is realistically the heaviest hard variable expense for us, right? Customer acquisition is a real thing. So you got to be aware of your customer acquisition cost. If your customer acquisition cost is less than your lifetime value of your customer, you're a profitable business. If it's more, you're not a profitable business. And if you want to just simplify, those are the 2 real things that you need to pay attention to. How much does it cost to acquire a customer? And then how much is that customer worth once I do? If it's positive, then it's positive. And then for us, really the heavy thing for us is salaries. And when we actually build our advisory business, one of our key goals right? So we have two key goals. One is $100 million portfolio, 100% in public. The other is operating at 50% plus margins after wages and expenses. And salaries is a big part of that, because people are what make companies great. Specifically in our type of business, people is the primary function. People are almost the product, right? So it's also where the cost lives for the most part. But again, most importantly, people make companies great. But it is a heavy part of the cost structure. All right, so that's the cost. Think about everything that goes into your business. Like, you can also include subscriptions, things like that. Like, really get a sense of what it's going to cost you to run. In our situation, I usually start at the cost structure, to be honest, when I'm modeling things out, because for me, following the Investpreneur's journey, it's like, by knowing what your cost is, realistically, that's how much you're going to potentially burn. So if you're an Investpreneur bootstrapping, that's how much is going to come out of your bank, right? So then the first thing that you're solving for is, how much revenue do I need to drive to match that, cover those costs? And like, from me, just coming from the school of bootstrapping, that's typically the approach that I have, that mentality, that thought process of, what are my costs? How do I get to cover costs fast? Because if I can cover my costs, I can operate indefinitely. And if I can operate indefinitely, I can build equity internally and then eventually, hopefully, win the game. So that's kind of like how I think about things, right? But again, that's just like what I do, right? So 8 is cost structure. Number 9 is jumping back on up, and we're now getting back to that unfair advantage. Again, unique value propositions, that's what makes you different in the eyes of your customer. Unfair advantage, what makes you different in the eyes of your competitors, right? For us, I think that the most important thing that's different about us is our SAFER agreement. It's quite literally ours. Nobody else can do it technically, legally. If they are, they're definitely infringing on quite a bit. But this is ours. This is uniquely our agreement, our structure. We think it's the most bootstrapper friendly. We think it's the most founder friendly, period, structure. We think that it's so well aligned. It is so perfectly aligned in every essence of every aspect of commercial capitalism in terms of both sides of the table, that it's just like almost perfect. And we're always optimizing, so we'll make it even better. We've made this better over the past 12 months since we incepted it. We're always going to be making it better. So we're going to try to drive it to be as close to perfect as possible. And then the other thing I think that's super unique about us is that we have this, we're a platform player, right? So at our core, we're a private equity firm. And when you look at all of these other players and alternatives in the market, which a great place to something I should probably asterisk and flag before getting into the unfair advantages, or simultaneously as you're getting into the unfair advantages, think about all the existing alternatives, right? Because you got to know your market to be able to figure out what makes you better than your market. You can also do that, I should have probably flagged it earlier, with your unique value propositions as well. But existing alternatives, everybody who's closest to you as a competitor. So in our world, our competitors are courses, right? Folks who just sell online courses. They are a competitor, even though they're like a very far off competitor. They're like kind of the bottom of the totem pole in terms of like our competitive competition. But whoever is extracting money, right? Your customers have a finite amount of resources, one of which is money and time, right? So if your competitor, a course, extracts capital or time from your customers, that's capital and time they can't invest with you. So whoever is pulling capital or time from your customer base is your competitor, right? And if they do a better job marketing, whatever the case. So in our situation, typically these courses are inferior, experiences or products to ours, but they're a real competitor. And they oftentimes have great marketing. So they're very good at marketing. Whereas as we get deeper into this, like these like PE firms, for example, are bad at marketing. It's funny how that goes. It's funny how that goes, to be honest. So outside of courses, you got communities. Like this is more of the lower end of the ranges. So you'll see a lot of our sub 100K portfolio companies going in that direction because they're more perceived to be more affordable or more accessible. Our structure is way better than them because we're aligned, right? And we're not just selling a course or something like that. We're trying to deliver an outcome, which is wedge equity, so that we can acquire a company, right? They will never actually write you a check. They will never buy you. They'll never do what we've invested in being able to do because we have a different, better business model. Middle of the road here is consultancies. Now, the bad side about consultancies and why we're better is their payment structure is not affordable, nor is it typically flexible. And it's typically higher priced because their economics are 100% based in the services they provide, whereas our economics are not only from the services, not only from the revenue repayment, the advisory structure, but also from for the future exits. So we have our equitable cash flow structure, revenue streams, and then we have our service-based revenue streams. They just have services. So we have an all in all better capital structure than they do. So we win. We're better. They have to ultimately charge more at worse terms. So because we are in a different situation and we are a platform, we are a private equity platform, we win. We have a better structure. Then you have accelerators and PE firms. And these are the folks that play in our invest and buy game. But they play in the invest and buy game, but what they don't do is the advisory stuff, the service side of it, right? So consultancies just do services. They don't play in the capital structures. Accelerators, PE firms, VCs, they play in the capital structures, but they're not really designed to deliver quality at scale and intentional value, right? The way that we are. Whereas we have a guarantee around the wedge equity that we're delivering because we're designed specifically for that purpose. Whereas an accelerator, PE firm, etc., they're more on the capital structure play side. They're capital allocators, right? So for those specific purposes, also the difference between our firm and other firms out there is we're designed to work with more folks than they likely are. We're more accessible to different types of deals, specifically like bootstrappers, for example, right? A lot of the deals that they look at, or a lot of the deals that we look at, we should say, they would look down on and they would look over. Whereas we are designed to be able to work with folks like ourselves. Realistically, we work with everybody. Realistically, we figured out how to make it make sense, and they just realize that it's not worth their time to try to even care to try to figure that out. So that's why we're different there. So that's our unfair advantage. Think about your own unfair advantage. Go through the same thought exercise. Think about competitors in market, what makes you different, how you win, right? Think about how you win. To wrap this up, we're going to talk about constraints and then we're going to go to risks. Constraints and risks sometimes overlap and sometimes can be thought about the same. I love constraints and risks because I'm a huge fan of constraint theory. I believe if you can identify a constraint in a business, then what you can ultimately do is either figure out how to resolve it, so remove it, right? Elevate and remove it, or you acknowledge it and you work within it, right? You build around it, right? By doing so, you can optimize for throughput. You could build a better, simpler business faster. I genuinely believe that if you get really good at identifying constraints and resolving constraints, you have a more profitable, simple, profitable business faster, right? Genuinely believe that for all the right reasons. In our situation, I'll keep it simple. Our constraints on success are deals, quality deals specifically. If you don't have the deal flow, you don't have a business. You can't sign safer agreements. There's no portfolio companies. There's no deals to be done. The second is delivery. So for us, the delivery is the simplicity of the operations. This is a fairly sophisticated business that we run. We definitely brand and promote simplicity, but at its core, if you really think about what we're doing, we're a micro private equity firm on steroids who provides a performance advisory with a performance capital, and we acquire companies. It's a pretty complicated, sophisticated business model, and we have a lot of IP that we developed to be able to deliver it. And the constraint on that is creating a simple productized experience that can scale. right? We deal with a lot of deals that are smaller, sub-market deals that other firms would never deal with or never look at. We've had to create a productized experience that allows for the operational efficiencies to be able to take that deal flow on. Meaning, like, our competitors in market, other PE firms, it's not worth their time to even write the check for some of the deals that we do, right? So it's like literally in their mind, it's not even worth the time. For us, I'm like, it is. We just got to figure out how. So for us, operational simplicity became the constraint. And the better we can simplify our operations, the better we can serve the market that we believe is underserved, right? So we do think that there's a massively underserved market here. And I feel like that's also that's a competitive advantage there. It's a unique competitive advantage of, our competitors don't even look at the market that we serve into. And then the last constraint is, of course, capital. That should be a constraint for everybody. For us, it's a unique constraint because it's a core part of our business. We need the capital to be able to not only operate like all organizations do, but quite literally to acquire and grow, right? We're quite literally in the business of buying businesses. So you need the capital to be able to underwrite the deals, to be able to acquire and net close to convert to build our $100 million portfolio. Now, the good news is that we're in the wedge equity business. So we help businesses build wedge equity, which means that our terms when we do deals are really great terms because we've put in the hard work to make that the case. We don't just use our money to solve problems. We put in actual effort to solve problems. And because of that, we get better, ultimately better terms that we've earned, which puts us in a better capital structure, which ultimately, because of the way that we structured everything, we have pretty good capital velocity. So it's not a huge constraint. But if we were to go upstream, up market in our deal structure, it likely could be. So it's something to pay attention to. So we do. Now, think about your own business. Think about what's in the way of you from doing more, right? And really think about it as like anything that you think could be in the way, and write it down, because this is critically important. And as we continue to work through and work and collaborate together, this is going to be a big part of what we solve for, is the constraints. Next thing and final thing that we're going to work through here is the risks, right? If you can acknowledge risks and ring fence risks and then remove constraints, that is your path to a simple, profitable business, as long as you're very simple and focused on everything else. And that's the value with all of this, is at the end of the day, it's to get focused and to get simple so you can execute, right? And then in terms of optimization, your optimization is to ring fence risks and remove constraints. That helps support your throughput. So in our situation, the risks that we face, capital markets can change, right? We buy businesses at certain valuations. At any moment, the perceived valuation of that asset could change. You could buy something for a 4 times multiple that's now only worth 2 times multiple, and you could be underwater, right? Like, things change, markets change. So that's a real risk that we have to stay on top of. Trends change in market, right? AI is popping up. Maybe certain businesses are become obsolete, right? Folks don't want it anymore. There's less of an appetite for resale value, et cetera, et cetera, et cetera. The other thing that we can't really control that's a risk is regulatory changes. Who knows? Maybe they change the laws and we're not allowed to do deals the way that we do them anymore, or whatever the case may be. That's a potential risk. That's something we need to pay attention to. And the last thing that we need to be aware of, right now, we are the number one in the market. We're the leaders in the market. We're the innovators in the market. We created this structure. We are the players in this market. But who knows, maybe as we continue to grow, we hit our $100 million goal, and now we're going for $1 billion, and then 10 billion, and then 100 billion, then $1 trillion. Who knows? Other people may be like, wow, those bootstrapper capital folks, they really figured something out special here. Let's copy them. And now you got copycats in the market, which is why having your moat and your unique value propositions and your unfair advantage is just so important. Because if you're successful, other people they become envious of that success. They want to follow suit of that success, and you have to be able to defend against the competition to keep your competitive advantage and keep your success. So again, this is extremely valuable, because if you were able to work through this, again, you have the freedom and luxury to pause, throughout this entire thing, totally perfectly okay if you did. It's okay if you came back to this. If you took multiple days to work through it, it is what it is. Right? It's extremely important, and it's awesome if you're able to work through this and just kind of put it down. And as we're talking through it, you're just typing it out. That's awesome. If you needed to pause, that's also perfectly okay. Right? Everything starts somewhere. We're starting here. The value is it's simple, and everything that you need to get focused on is on one sheet of paper. And then ultimately everything that you need to solve for over time is also inventoried, right? This is a working model. This is a working exercise. We're going to continually revisit this, right? Once we set up our operating system, we're always going to be optimizing, right? It's built for always be optimizing, right? One of the things that we say. This is the end of this module. This is the end of the lean canvas. At this point, make sure that you are working inside of your operating system. I know I may have failed to say that at the beginning. Please make sure that that's the case. Please make sure you're connected to the internet, that everything saves itself. But again, you can always come back. You could always revisit this. And hopefully you found some significant value in this workshop, setting up your lean canvas to keep it simple.